I'm with Metrika. We're building a real-time digital asset risk and compliance platform for digital assets. I'm here this morning to talk about blockchain networks as financial market infrastructure and to highlight the risk layer beneath digital asset markets and how it gets monitored at the speed that blockchain networks move. So why are we having this conversation now? A large part of it is because institutions are on chain. We're not the only ones saying blockchain networks are becoming financial market infrastructure. It's our clients as well, GSIBs, asset managers, credit rating agencies, and more. They're already on chain. They're trading, they're managing collateral, they're issuing tokenized assets, and they're operating blockchain-based applications. We're also seeing legislation advancing. There was talk earlier of the Clarity Act and how it's about to head for a Senate floor vote. But I think the most important thing here too is that blockchain-based networks never close. They operate 24/7, 365. And from our perspective, building a risk management platform, operational risk emerges continuously. It emerges in minutes, if not seconds. And the gap between risk emerging and risk escalating and being able to mitigate that is what we're working to close. So when you think of blockchain-based networks as financial market infrastructure, the network itself becomes infrastructure because we're seeing blockchain networks clear, settle, and keep records of transactions on an ongoing basis, 24/7, 365. And a large part of this, before we even get to the monetary value of the digital assets, the tokenized real-world assets on top, money market funds, and so on, we focus on the inherent risks, right? So digital asset infrastructure risks like validator concentration, consensus failures, smart contract vulnerabilities, transaction execution, settlement finality, cyber incidents, network degradation, and governance failures. And so our perspective at Metrika is highlighted in what we call the risk iceberg. Typically, in the past few years, when people talk about digital asset risk, KYC, AML often comes to mind because that's what has been ported over from traditional finance. And so you have a number of companies that have already solved the KYC, AML aspect. For us, we've been building this space. We've been around since 2020. We're also venture-backed as well too. So we've been quietly building. And for us, when we look at risk, there's this entire risk iceberg highlighting the number of risks that I already mentioned, but I just want to point out a couple of key risk indicators or indicators associated with that. So validator concentration, transactions per second, finality, uptime, even smart contract, right? Compiler audit status, has a smart contract been audited? When was it audited? Any known bugs that appeared? Have the bugs been addressed? Any key changes? Even with staking and DeFi, exit queue time, slashing events, activation time, stake supply ratio. And then there's a whole sanctions, reputational compliance aspect, looking at OFAC, FCDO, sanction address tracking, SDN list monitoring. Centralization is a really big one when it comes to public blockchain networks, Nakamoto coefficients across staking, nodes, cloud, geography, client diversity. And then a really important one too, DPEG percentage when it comes to like asset and market stability, DPEG percentage, drawdowns, trading volume, whale activity, and supply concentration as well. So these are the key risk indicators, as we call them, that we keep track of at Metrika, given the nature of blockchain networks operating 24/7, 365. So last month we sent a letter in support of the Clarity Act to the Senate Banking Committee, and in many ways, we welcomed the Act's risk management provisions. So I'll call out two: Section 308 on risk management standards for digital asset intermediaries, looking at market manipulation, fraud, sanctions evasion, and then more importantly, they called out operational and cyber risk. I think that's a really key provision. And then Section 505, looking at tokenized securities as securities. For us, we also highlighted that, again, blockchain networks are critical infrastructure, and they belong inside institutional operational risk frameworks, which I'll get into in a bit. And a large part of our approach here is continuous monitoring is needed, because again, blockchain networks operate 24/7, 365, and then point-in-time assessments just don't cut it, where you say, we're going to assess our network every quarter, every 6 months, every year, networks that we operate on. So it can't keep up with 24/7 markets, periodic assessments, you have annual reviews, quarterly attestations. It's a snapshot of risk at a point in time. But risk goes unmonitored between assessments, and that's the big issue that we're solving. With continuous monitoring, again, you're looking at the infrastructure, networks, validators, smart contracts, settlement systems, governance mechanisms, and transaction activity. And the whole goal of what we're trying to enable, financial institutions and even regulators to do is to identify, monitor, and escalate these emerging operational risks in real time. And so when we take a step back and we look at the bigger picture, what we're seeing with the likes of GBBC, Oliver Wyman Risk Mitigation Framework, the Global Layer 1, led by the Monetary Authority of Singapore and a number of other regulators, and even coming out of the DTCC, the Digital Asset Securities Control Principles, is standards beginning to emerge on what risk frameworks should look like. And then when we look down, or when we go zone in onto institutions implementing these digital asset risk frameworks, what we found in our work is that these risk frameworks have typically been worked on internally for a year or two or even longer, approved by a board level risk committee and aligned with the global institutions enterprise risk management framework, where more often than not, the output is an Excel-based spreadsheet with the different risk categories that are outlined, different risk questions that are in line with the enterprise risk framework, and then metrics that they should be monitoring. And then the key question is, okay, so this is great for pilots, this is great for one-off tokenized bond pilots, but what happens when you begin to scale internally and go into production? All of a sudden, legal compliance risk comes in, and the questions ask, well, what's our exposure to blockchain networks as we continue to scale up? So with the digital asset risk framework in place, our goal at Metrika is to operationalize that. And then with supervisors, not just point-in-time assessments, but ongoing monitoring, they can confirm institutions do what they're committed to doing, reporting, examinations, and evidence. And so what you're seeing emerge across industry is industry, financial institutions, and supervisors are beginning to work hand in hand at the speed of blockchain networks 24/7, 365. And so let me take you through what we call the digital asset risk lifecycle for a financial institution. When they start off, an institution would think, okay, we want to, for example, launch a tokenized money market fund. They are going to do due diligence on a number of different layers. So they're going to look at a number of different networks, for example. So Solana, Avalanche, Stellar, Ethereum, a number of others. They're going to look at these networks using their risk framework as the key piece to it. What we're able to do is put together the due diligence assessment that enables them to do it a lot faster. But because key risk indicators are automatically associated with the due diligence process, right off the bat, once they have an assessment, they can either accept with conditions or completely reject, an asset or a network or an application. They'll have continuous monitoring on an ongoing basis, again, based on their digital asset risk framework. Then there's the reporting function that they do either to their CRO, the chief risk officer, or to their board, or to supervisors. And then you go into mitigation. You can offboard an asset, you can do compliance reporting, automatic risk controls, stakeholder management, and infrastructure adjustments based on the key risk indicators and the signals that you're seeing emerge from, again, blockchain networks being this financial market infrastructure. And yesterday in the panel, we talked about what does AI unlock. A large part of this is because blockchain networks are moving 24/7, 365. Our stance is that AI with the right guardrails in place can help monitor that infrastructure on an ongoing basis and can help build new controls associated with that. So what makes it safe with AI is verifiable data that is live, auditable, verifiable, and then traceable to the source, right? So every data point is traceable to the source. Business logic and workflows, right? So you need, like in an enterprise setting, business logic and workflows is really important. This is where the digital asset risk framework comes in. And then the third piece is human in the loop. There's got to be a risk officer, a risk analyst, or the chief risk officer signing off on it, because what AI in many ways, or these platforms pulling together these data points, they can gather the evidence, they can structure them, but it's really that human at the end that comes in and verifies it and makes sure that everything is up to par. right? So due diligence goes from weeks to minutes. So you go from Excel, spreadsheet, manual based to automated. Monitoring is 24/7, 365, and we have 4,000 key risk indicators, and that's only going to increase with more networks, with more digital assets, with more tokenized money market funds, and so on. Reporting goes from days to minutes. You could even program it to create audit-ready outputs, and then mitigation goes from hours to minutes as well, to keep up with pace of the 24/7, 365 nature of blockchain networks. And then finally, the last slide. So it's great. From our perspective, as legislation advances, especially with the Clarity Act, one thing that, again, we're looking at is blockchain networks are becoming critical financial infrastructure. They belong inside institutional operational risk frameworks. Number two, our oversight should expect continuous real-time monitoring of blockchain networks, validated infrastructure, smart contracts, transaction activity, settlement systems, and not periodic attestations alone. And then the operational resilience should remain a core component of it in order to ensure the safe and soundness of financial markets as everything moves on chain. We've submitted a letter. You're welcome to read it, and thank you for the opportunity to present this.